The financial markets were thrown into turmoil when 20 key US allies, led by Japan, the United Kingdom, and Saudi Arabia, executed a massive sell-off of US Treasuries. This unprecedented move came in direct response to newly elected President Donald Trump's sweeping trade tariffs, which he announced as part of his aggressive economic policy aimed at reversing trade imbalances. The abrupt action sent shockwaves through Wall Street, triggered concerns of a global economic shift, and left the US government scrambling to contain the fallout. Before we start, smash the like and subscribe buttons for more updates. US Treasuries have long been the bedrock of global finance, serving as the safest and most reliable store of value for foreign governments and institutional investors. The decision by these 20 nations to offload their holdings marked a dramatic departure from the norm, signaling a profound loss of confidence in American fiscal stability. Japan, the largest foreign holder of US debt, had historically relied on treasuries as a crucial component of its monetary strategy, using them to stabilize the yen and ensure steady financial ties with Washington. The UK, another major investor, had always maintained robust economic ties with the US, while Saudi Arabia leveraged its holdings for political and economic influence. Their simultaneous and coordinated sell-off suggested not only economic discontent but also deep political unease with the new administration's approach. The sell-off, which unfolded rapidly in the days following Trump's announcement, sent US bond prices plummeting and pushed yields sharply higher. Investors around the world scrambled to assess the implications of the sell-off, with many fearing that higher borrowing costs could put pressure on the American economy. The ripple effects were immediate and severe. The US dollar, long regarded as the world's dominant reserve currency, faced sudden depreciation, leading to panic in foreign exchange markets. Global financial institutions, wary of the volatility, began repositioning their portfolios, shifting away from dollar-denominated assets and seeking stability elsewhere. For Washington, the consequences of this move were nothing short of alarming. The U.S. government relies heavily on foreign purchases of treasuries to fund its budget deficits and maintain liquidity in the economy. A large-scale withdrawal of foreign investment threatened to create a funding gap that could only be closed by either drastically increasing domestic borrowing or raising interest rates, both of which pose significant economic risks. Rising interest rates would not only make it more expensive for the government to service its debt, but could also trigger a slowdown in economic growth, particularly in sectors reliant on cheap credit such as housing and consumer spending. The Federal Reserve found itself in a precarious position as it struggled to navigate the chaos. Normally, the central bank could intervene to stabilize the market by purchasing treasuries and injecting liquidity, but doing so would require a delicate balancing act to avoid exacerbating inflationary pressures. With inflation already a concern due to supply chain disruptions and rising wages, the Fed was constrained in its ability to act decisively. Market analysts speculated that unless immediate measures were taken to restore confidence, the Treasury market could face a prolonged period of instability, further eroding the appeal of U.S. debt instruments on the global stage. Beyond the financial sector, the sell-off carried profound geopolitical implications. The decision by Japan, the UK, and Saudi Arabia to lead this charge signaled a collective rebuke of Trump's trade policies, which many saw as economically short-sighted and diplomatically reckless. Japan, traditionally a staunch US ally, had long supported open trade policies and viewed tariffs as a dangerous precedent that could escalate into a full-blown trade war. The United Kingdom, grappling with its own economic uncertainties following Brexit, had no interest in a confrontation with Washington, but saw the tariffs as a direct threat to its financial sector and export-driven industries. Saudi Arabia's participation in the sell-off was particularly striking given its historically close ties to the U.S., suggesting growing frustration with the administration's unpredictability in both economic and foreign policy matters. The repercussions extended far beyond these key players. Other nations that had substantial holdings in U.S. treasuries, including China, Germany, and France, closely monitored the situation, weighing their own strategies in response to the shifting economic landscape. While some countries refrained from immediate action, the possibility of a domino effect loomed large. If more nations followed suit and offloaded their holdings, It could trigger a self-perpetuating cycle of declining demand for U.S. debt, leading to a sustained rise in borrowing costs and a weakening of the dollar's global standing. Financial markets braced for impact as stock indices in the U.S. and abroad suffered steep declines. Investors, rattled by the uncertainty, pulled back from equities and sought refuge in alternative assets such as gold and cryptocurrencies. Wall Street analysts scrambled to assess the long-term implications of the sell-off, with some warning that if confidence in US Treasuries continued to erode, it could challenge America's status as the world's leading economic superpower. As Washington grappled with the crisis, policymakers faced mounting pressure to respond swiftly. Some lawmakers called for diplomatic engagement to reassure foreign investors and mitigate the damage, while others advocated for retaliatory measures against the countries that had participated in the sell-off. Trump, known for his combative rhetoric, was unlikely to back down from his tariff policy, setting the stage for a prolonged standoff with key trade partners. The administration's economic advisors scrambled to devise a strategy to stabilize markets. But with so many variables at play, finding an effective solution proved challenging. Meanwhile, ordinary Americans began to feel the effects of the turmoil. Rising bond yields translated to higher mortgage rates, making home ownership less affordable. The cost of borrowing for businesses increased, leading to reduced investment and hiring. Inflationary pressures intensified as the weaker dollar made imported goods more expensive, squeezing consumers already grappling with economic uncertainty. Small businesses that relied on global supply chains faced disruptions as tariffs led to higher input costs, forcing many to reconsider expansion plans or even lay off workers. In international circles, the sell-off raised broader concerns about the future of U.S. economic leadership. The dollar's status as the world's reserve currency had long been underpinned by trust in the stability of U.S. financial markets. If that trust eroded, alternative financial systems could emerge, challenging the long-standing dominance of the American economy. Some economists speculated that China and the European Union might seize the opportunity to push for a greater role for the yuan and the euro in global trade, potentially reshaping the international financial order. Amid the uncertainty, questions loomed about how the U.S. would restore confidence in its economic policies. Would Trump double down on his protectionist stance, further alienating key allies? Or would his administration be forced to soften its approach in the face of market backlash? The lack of clarity only added to the volatility, leaving investors and policymakers alike in a state of anxious anticipation. As the sell-off continued to reverberate across global markets, one thing became clear: the world had entered uncharted territory. The consequences of this dramatic shift in financial dynamics would take time to unfold. But the immediate impact had already reshaped the economic landscape. The U.S. found itself at a crossroads, facing a critical test of its economic resilience and diplomatic acumen. Whether it could weather the storm or whether this event marked the beginning of a deeper shift in global power dynamics remained to be seen. The immediate effects of the sell-off were felt in bond markets, where investors struggled to grasp the full implications of the massive exodus from U.S. Treasuries. As yields surged to levels not seen in decades, borrowing costs skyrocketed for both the U.S. government and private businesses. The Federal Reserve, caught in a difficult position, had to weigh whether it would intervene to stabilize the market or allow interest rates to rise as a natural consequence of diminished demand for U.S. debt. The central bank's hesitation only fueled further uncertainty, leading to increased volatility across financial markets. Investors worldwide began reassessing their portfolio allocations in response to the seismic shift in global financial dynamics. Traditionally, U.S. Treasuries were considered the safest asset available, serving as the foundation for financial stability in times of crisis. However, the coordinated sell-off by major economic powers called that assumption into question. Hedge funds and institutional investors, wary of further disruptions, accelerated their exit from dollar-denominated assets, seeking shelter in alternative investments such as European bonds, commodities, and even emerging market securities. This diversification away from U.S. financial instruments indicated a potential long-term shift that could fundamentally alter capital flows and global market stability. At the same time, the corporate sector faced an unprecedented challenge. US businesses, which had relied on low interest rates for years, suddenly found themselves operating in an environment where borrowing costs had surged almost overnight. Amid the uncertainty, questions loomed about how the US would restore confidence in its economic policies. Would Trump double down on his protectionist stance, further alienating key allies? Or would his administration be forced to soften its approach in the face of market backlash? The lack of clarity only added to the volatility, leaving investors and policymakers alike in a state of anxious anticipation. As the sell-off continued to reverberate across global markets, one thing became clear: the world had entered uncharted territory. The consequences of this dramatic shift in financial dynamics would take time to unfold, but the immediate impact had already reshaped the economic landscape. The US found itself at a crossroads, facing a critical test of its economic resilience and diplomatic acumen. Whether it could weather the storm, or whether this event marked the beginning of a deeper shift in global power dynamics, remained to be seen. The immediate effects of the sell-off were felt in bond markets, where investors struggled to grasp the full implications of the massive exodus from US Treasuries. As yields surged to levels not seen in decades, borrowing costs skyrocketed for both the US government and private businesses. The Federal Reserve, caught in a difficult position, had to weigh whether it would intervene to stabilize the market or allow interest rates to rise as a natural consequence of diminished demand for US debt. The central bank's hesitation only fueled further uncertainty, leading to increased volatility across financial markets. Investors worldwide began reassessing their portfolio allocations in response to the seismic shift in global financial dynamics. Traditionally, US Treasuries were considered the safest asset available, serving as the foundation for financial stability in times of crisis. However, the coordinated sell-off by major economic powers called that assumption into question. Hedge funds and institutional investors, wary of further disruptions, accelerated their exit from dollar-denominated assets, seeking shelter in alternative investments such as European bonds, commodities, and even emerging market securities. This diversification away from US financial instruments indicated a potential long-term shift that could fundamentally alter capital flows and global market stability. At the same time, the corporate sector faced an unprecedented challenge. US businesses, which had relied on low interest rates for years, suddenly found themselves operating in an environment where borrowing costs had surged almost overnight. Large multinational corporations, especially those engaged in capital-intensive industries such as manufacturing and infrastructure, were forced to rethink expansion plans. Many delayed investments or canceled projects altogether, fearing that the economic uncertainty triggered by the Treasury sell-off would translate into lower consumer demand and reduced profitability. The banking sector, too, was deeply affected by the unfolding crisis. U.S. financial institutions, heavily exposed to government bonds, experienced sharp declines in their stock prices as fears mounted over potential losses. Regional banks, in particular, faced liquidity concerns as rising yields eroded the value of their bond holdings. The Federal Reserve's ability to provide support was limited, as excessive intervention risked further damaging investor confidence. International banks with significant exposure to U.S. assets also began reassessing their risk profiles, with some considering a shift in lending practices to avoid prolonged exposure to a potentially unstable dollar. Beyond the financial turmoil, the geopolitical ramifications of the sell-off were profound. The coordinated nature of the move indicated a level of strategic cooperation among nations that had rarely been seen before. Countries that had long been considered close allies of the United States were now openly challenging its economic policies in a manner that suggested a willingness to forge new alliances. This shift threatened to weaken Washington's influence over global trade negotiations, military alliances, and international regulatory frameworks. China, while not directly participating in the initial wave of Treasury sales, closely monitored the situation. The Chinese government had long sought to reduce its reliance on the U.S. financial system, advocating for a more diversified global monetary order. The sell-off provided an opportunity for Beijing to advance its economic agenda, promoting the yuan as an alternative reserve currency and deepening financial ties with nations seeking to reduce their exposure to U.S. assets. China's state-run media wasted no time in highlighting the instability of the U.S. market, reinforcing narratives that the American economy was becoming increasingly unpredictable under the new administration. In Europe, the reaction was mixed. While the UK's involvement in the sell-off suggested deep concerns about Trump's trade policies, the European Union as a whole remained divided on how to proceed. Germany and France, both major holders of U.S. debt, hesitated to follow the lead of Japan and Saudi Arabia, fearing that a further escalation could lead to a full-scale financial crisis. European policymakers were already grappling with economic challenges of their own, including inflationary pressures and energy shortages, and were reluctant to engage in an action that could further destabilize global markets. Meanwhile, Russia saw the crisis as an opportunity to assert greater influence over global financial affairs. The Kremlin had spent years reducing its exposure to the US dollar, increasing its holdings of gold and other non-dollar assets. With Washington's economic dominance now under threat, Russian officials intensified their calls for a multipolar financial system, advocating for trade agreements that bypass the dollar entirely. Moscow's push for alternative payment mechanisms gained traction in several emerging markets, which saw the Treasury sell-off as a sign that the global financial order was shifting in an irreversible direction. In the Middle East, Saudi Arabia's decision to participate in the sell-off marked a major turning point in US-Saudi relations. Historically, the kingdom had maintained a close financial and strategic partnership with Washington, relying on its vast holdings of US Treasuries as both an economic asset and a diplomatic tool. However, the new administration's unpredictable approach to trade and foreign policy had introduced a level of uncertainty that made continued investment in US debt less attractive. Riyadh's move raised questions about the future of the petrodollar system, which had long been a pillar of US economic strength. If Saudi Arabia began diversifying its foreign reserves away from the dollar, it could trigger a broader rethinking of global energy markets, with far-reaching consequences for oil prices and international trade. Domestically, the crisis had profound political implications. The newly elected administration, which had campaigned on promises of economic revitalization, now faced its first major financial test. Trump's advisors found themselves under immense pressure to reassure investors and restore confidence in U.S. markets. Treasury Secretary appointees scrambled to communicate with foreign counterparts, attempting to dissuade from further liquidating their holdings. The White House issued statements downplaying the severity of the situation, but the damage was already done. Perception was everything in financial markets, and the perception of declining confidence in U.S. debt was enough to drive further volatility. Congress was deeply divided on how to respond. Some lawmakers, particularly those aligned with the president's economic nationalism, saw the crisis as a necessary step in recalibrating America's trade relationships. They argued that the sell-off was an overreaction and that the U.S. economy was strong enough to withstand temporary disruptions. Others, however, warned that unless immediate steps were taken to reassure investors, the Treasury market could face a prolonged period of instability. Calls for bipartisan action to address the crisis grew louder, but political infighting made swift decision-making difficult. As ordinary Americans watched the crisis unfold, anxiety grew over its potential impact on their personal finances. Retirement funds, many of which were heavily invested in bonds, saw sharp declines in value. Mortgage rates climbed, pricing some potential home buyers out of the market. The cost of consumer loans rose, affecting everything from car purchases to small business expansions. The ripple effects extended into the job market as businesses that relied on affordable credit to finance operations began scaling back hiring plans. The psychological impact of the sell-off could not be ignored. Market confidence is as much about perception as it is about fundamentals, and the sight of major global powers divesting from U.S. assets sent a troubling message. Economists debated whether this was a temporary market correction or the beginning of a more permanent shift away from U.S. financial dominance. Regardless of the answer, one thing was clear: the international economic order was entering a period of profound uncertainty. Looking ahead, the U.S. faced several difficult choices. It could attempt to stabilize the market by offering higher yields on treasuries, but this would increase the cost of government borrowing and potentially lead to deeper deficits. Alternatively, it could pursue diplomatic engagement to mend trade relationships and rebuild trust with foreign investors. The Trump administration's willingness to take such a conciliatory approach, however, remained in doubt, given its hardline stance on economic nationalism. The situation also posed a challenge for global financial institutions such as the International Monetary Fund and the World Bank. These organizations, which had traditionally operated under the assumption of U.S. economic leadership, now faced pressure to adapt to a world where confidence in American financial stability was no longer a given. Discussions emerged about the need for a more diversified global reserve system, with some advocating for a shift toward a basket of currencies rather than exclusive reliance on the dollar. As markets continued to react, the long-term consequences of the sell-off remained uncertain. Would foreign investors gradually return to US Treasuries once the immediate shock subsided? Or was this the beginning of a structural decline in demand for American debt? Would the US be forced to rethink its economic policies, or would it double down on its protectionist approach? And most importantly, how would this crisis reshape the global balance of economic power? The Treasury sell-off was not merely a financial event, it was a turning point in the geopolitical and economic landscape. The choices made in the coming months would determine whether the U.S. could maintain its position as the dominant force in global finance, or whether the world was on the verge of a fundamental realignment. The answers to these questions would not come overnight, but the sell-off had set in motion forces that would shape the trajectory of global economics for years to come. The shockwaves from the Treasury sell-off extended into unexpected corners of the global economy, reshaping investment strategies, monetary policies, and even technological developments in finance. Sovereign wealth funds, which traditionally held a significant portion of their reserves in U.S. debt, began exploring alternative safe haven assets, accelerating interest in digital currencies, blockchain-based financial instruments, and gold reserves. Central banks across Asia and the Middle East started adjusting their reserve policies, reducing their exposure to U.S. dollars in favor of more diversified holdings. Meanwhile, global trade negotiations took on a new sense of urgency. Countries that had previously relied on the U.S. as a central economic anchor began exploring regional trade agreements to hedge against American market instability. The European Union, China, and emerging markets engaged in discussions about reducing dependence on dollar-based transactions, fueling speculation about the rise of alternative financial infrastructures. Amid these shifts, the U.S. faced an existential question: could it maintain its financial dominance in a rapidly changing world? Or was this sell-off a warning of deeper systemic vulnerabilities? With confidence shaken and economic realignments underway, the long-term stability of the American-led global order was now more uncertain than ever before. If you liked this video, please give it a like and subscribe to our channel. Also, leave your comments below and tell us, what are your thoughts on 20 allies dumping US Treasuries? We want to hear from you. Thank you for watching, and see you next time.